So that's that. Right, it's been an hour. I would like to quickly talk about this thing over here, okay? And I'm going to speed through this. So I've done a lot of the calculations and drawing. I mean, normally it's my little stickmen drawings that take most of the time. So I've done most of the work because I think you guys are all clued up anyway, and you've probably seen some of the stuff here. But I just wanted to, stop falling for the compounding interest fallacy. It's bullshit peddled by fund managers, and that is so true. So the bullshit or the bollocks that is peddled is like, hey everyone can be a millionaire. All you need to do is rely on compounding interest. So set up a pension, an ISA, or whatever thing that they're pushing, and then just simply contribute to it every month for the rest of your life. And then by the time you're old and can't do anything, you'll be a millionaire. So that is, I guess, the con that's being peddled. Now, the reason why stuff like this is peddled, like in Tony Robbins' book and all that sort of stuff, is because it's the fund managers who make an absolute shit ton of profits from this. Because if everyone's putting their money into a simple tracker fund or a pension or a mutual fund or whatever, it's the fund managers that have their expense ratio. So typically a fund manager will make, or a fund will make, anything from like 0.1 to 1% per year, annual management fee, etc. So when you have billions and billions, or every IFA on the planet recommending people's pensions into some sort of fund, well, guess what? The fund managers are making an absolute fortune. So that is why it's being peddled. And you have to look through, you need context. And that's why I can see this and why a lot of people can't. So here we have two people. I think we should call them Jack and Jill. Jack and Jill went up there. Who's it? I can't remember the nursery rhyme. Which is the one that fell over? Was it Jack or was it Jill? I can't remember. In fact, it's highly relevant.
Jack fell down and broke
Jack.
his hand.
Okay, so it's Jack. Yeah, so he's the worse off one here. So it's probably good in that good naming. So we have two people, right? And they are 10x apart in their personal finances. So Jack, I would say, average-ish person. I guess he's doing all right because every month he's got a monthly surplus. And when I say monthly surplus, what I'm probably meaning is like, he's probably, taking home £2,000 a month. His outgoings are 1,500 quid a month, and therefore he's got 500 quid a month surplus. I mean, hell, he could be earning £1,000 a month, and his outgoings are 500 quid a month, and he's still be in the same boat. Okay, so it doesn't really matter. But I guess this was average. If you're good with your finances and living frugally, that's not bad. That's achievable. So every month he's very disciplined, and he puts 10% of his monthly surplus into his investment pot. So that's 50 quid. Every month goes into some sort of pot, and he's managed to save up. Let's say Jack is 35, 40 years old, probably got 10 grand saved up over the last 20 years or so, and so he's got 10 grand. Okay, so he's doing well. Okay, by all respects, this is actually a successful person, because there was a really good meme going around Facebook saying that you are successful if you have a food in your belly, roof over your head, warmth at night, and dreams and stuff like that. You've probably seen that meme, and I completely agree. Now, on the flip side to this, we have Jill, the wiser of the two. Let's call them brothers and sisters, and she has evidently, looking at her stats here, she's obviously gone into business, no doubt. So she has a business or more. She's getting £5,000 a month monthly surplus. She puts, again, same thing. So long story short, she's 10x Jack. Now, let's say they both make 10% ROI every single year. Hell, they probably put it into the same asset. Who knows? Well, due to compounding interest, this is what happens. So after year 30, Jack's 10 grand plus his 50 quid a month turns into 283 grand. Now, a lot of people go, oh, that's pretty good. 10 grand into 283 plus, don't forget your, 600 quid a year contributions. Well, assuming Jack is, 70 years old by this point. Yeah, so let's say he's 40 now, in 30 years' time he's there. Well, I know technology is getting better, so let's just say he's going to live to the ripe old age of 100. Okay, so it's another 30 years. Well, 283060 divide that by 30, that means he has to live on £9,435 per year, which is, divide that by 12, £786 a month. His total life savings. Now, in 40 years' time, or 30 years' time, that probably won't buy you a Starbucks. But yeah, so he's going to struggle. He'll be probably below some sort of poverty line, etc. Now, on the flip side, if Jill, 2.83 million, divide that by 30 years, that's it's about 283 million 830. Divide that by 30. Yeah, so she's got 90. Sorry, it's the other way around. Yeah, I can just remove some of the decimal points. So basically, she'll have 94 grand ish per year to live off. So that's good. She's done well. Now, here is where I guess I'm getting to in terms of, I guess I'm talking about the rich-poor divide as well, because what tends to happen is that people go, hey, rich-poor divide is getting bigger, the poor are getting poorer, the rich are getting richer, which is what we're seeing right now. I mean, all the small business owners in the UK are getting absolutely bent over, whereas the big boys are getting richer and richer. But Musk, Bezos, Bill Gates, all their fortunes are getting they're swelling. Now, basically, let's just say the masses lobby the government, and the government go, right, okay, yeah, we'll have some sort of big old 40% tax hike. Hell, it could be 40% CGT, I don't know. But typically what happens, and the reason income tax happened in the first place, if you don't know, is that there was this big rich-poor divide argument, hundreds of years ago. And so what happened is that the government went, yeah, okay, well, we will start taxing the rich a bit more. So, and they brought in income tax and all other sort of taxes. But what happens is that the smart, or the wealthy, they look at workarounds. So they sort of insulate themselves better. And then eventually what happens over time is that big old tax just ends up falling on the middle class and lower class. And it just makes the rich-poor divide even worse. But I'm just saying, if you ever get some sort of massive pay cut, or your income is reduced massively, just like 2020 for pretty much everyone, including myself, I've been slapped all over the face with a big stick, 2020. And yeah, so in Jack and Jill's case, they both had their income, swiped by 40%. But now, all of a sudden, it's, shit. 283, I think I've done yeah. So it doesn't seem too, actually, in looking at the stats over here, it doesn't seem too different. But I guess, in fact, probably what I should have done is put some charts in here of the compounding growth. The point I really wanted to make is that compounding growth, as in, compounding interest, it is the eighth wonder of the world, and I do admit that. But you shouldn't rely on it so that in 30 years' time, you get rich, okay? Because, just look at the jumps in wealth. So over here, in just simply a 10-year period, what is the actual jump in growth of Jack's pot? It's 89k, what do we call it? Roughly 90k and 32. So it's roughly a 58 grand jump just using compounding interest. But simply because Jill has bigger numbers, in that same time period, she didn't jump up 58 grand. She jumped up like 500 grand-ish in that same time frame, simply because she started with higher numbers. So the thing with compounding growth, if we just go sideways a bit, is that you need to start, so if we look at the growth curve in terms of compounding growth, it is like this. It's like, we've all seen that curve. So instead of starting over here and then patiently waiting until you get to the hockey stick bit over here, why don't you just do something different and go, right, okay, well, screw this bollocks over here, just parking money and hoping, it does well. Do something different and then basically start here. So you should start your saving where your pot is effectively at that point in Jack's curve, if that makes sense. Now, how do you do that? The fact that you're here today you're pretty much already looking at alternate things. I mean, for myself, it's business and trading. They sort of go hand in hand, but ultimately you need a different vehicle to get you here. If you do want to sort of skip, you need a different vehicle, if that makes sense. I guess it's like it's a 26-mile marathon, and you simply jump in the last mile and take all the glory instead of actually doing the long slog. So, and I guess the rich poor divide will always continue, and the main reason being is that people like Jill have three things on their side which people like Jack typically don't. And I mean, I realised this about 10 years ago, and ever since these three things have sort of stayed in my head. Now, I've only focused on two of them. So, first of all, let's start with tax efficiencies here. So, yes, you can be tax efficient, and there's obviously different variations of tax efficiency. So, I haven't got any overseas companies and offshore accounts and stuff like that, because the way I've thought of things is that screw this is sort of not really a growth type mindset. So what I've basically said to myself, I'm just going to focus on capital arbitrage and vehicle for growth, because it's a positive way of going around things, and that eventually, if I've got ridiculous amounts of money, maybe I can look at tax efficiencies to get save a few million or whatever. But for the meantime, I've sort of ignored that. But the rich in general, they make their wealth and they harbour it and they protect it. And this is really more of a protection mechanism. But you have to focus on these two, capital arbitrage and vehicle for growth. So capital arbitrage is, I think, probably the most important thing. And it's sort of, these two are actually combined hand in hand. And it's simply using maths. It's simple maths. So if you have the ability, and this is the key thing, the ability, the hard fast ability to arbitrage an ROI, that is a ticket for making money, if that makes sense. So if you have a vehicle and you can hang your hat on it that it will make 20% per year, every year, even in a bad year, well, why wouldn't you go out and get as much freaking debt as possible? Because you could then simply go out and borrow money at 10%. Like, you could go out and make, borrow £10 million at 10%, or £1 million, or hell, whatever is relevant to you, 100 grand at 10%. But you're going to make 20% on that. So there's a simple arbitrage between these two things. And when you look at all the big companies on the planet, that's all they do. That is all they do. It's simple arbitrage. They simply go out and borrow shitloads of money. They go out and buy all the customer base that they need, and they're paying whatever. In fact, they're paying a lot less than 10%. Most of the time, they're paying probably, if they're doing debt-based stuff, they're probably paying between 2 to 6% in terms of a bond of some sort. But they know that their business model is making 20% or more, depending on what sort of company you are. And so it's just a simple arbitrage. But when you talk to normal people, like I always use my extended family because they are the complete polar opposite to me. And in fact, just talking about money looks like I've just sacrificed a baby lamb in front of them at Christmas dinner and started eating it raw. Like, that's how bad the topic of money is. I mean, hell, I'd probably get away with talking about COVID a lot easier than talking about money at that sort of dinner table. But yeah, even the thought of borrowing money to put into a business or something is like, it scares most people. But when you can sort of get over that barrier and become obsessed with capital arbitrage, honestly, that is a ticket to real fun times. And part of this, when we're looking at the vehicles for growth, it's not just business. So for me, my trading, I know that if I apply myself and I don't stop dicking around, or if I have a safe account, I know that I can grow it, 10 to 20%, safely without big drawdowns. Because obviously you can have any ROI you want with trading, but it's that seesaw of, risk to reward. If you accept higher risk, you can have higher, reward. But with a fair amount of drawdown, as an acceptable amount of drawdown, I can easily make 10 to 20% a year. Well, and this is how I grew my trading account in the first place. I simply went out and got some freaking loans. Now, I'm not saying that you should all go out and do this, but at least put this into the back of your mind. So in any time from 2 to 5 years' time where you're feeling pretty damn happy about your trading, then maybe explore it. But really, actually, the thing that gives you the best arbitrage in terms of vehicles for growth is business. I really would recommend that. And this is not a shameless plug, because I have no shame about this whatsoever. That is the sole reason I created the WAP, the Wealth Action Plan. The whole reason of the WAP is to help you get into a business or it's the internet. My internet is so shit. Honestly, it's ridiculous. Okay. So well, I'll be having words with my web developer here. What's going on? Videos aren't even working. But yeah, just check out the WAP. Just do the 30-day chance, like a quid. Helps you in terms of the vehicle for growth. Yeah, so I'm looking at the chat box. There's quite a few things. So Matthew said, however, Jack leaves it invested and still makes 10% a year, then he can live on 20. Even though 28 will be taxed, it still won't be enough. Yeah, I mean, obviously you can do lots. I mean, I've just tried to make this as really simple as possible. He can do lots of different things, Jack and Jill. But yeah, you sort of, hopefully you get the gist. I guess the main thing I was trying to point out is that don't try to be rich when you're too old to do anything with it, and you'll end up just passing it to your family. It's better to bust a gut now for 10 years and get to this hockey stick part in a 10-year time frame, not in a 40-year, 30-year time frame. And it's doable. Easily doable.